Everything you read about this Iran deal this weekend is missing the biggest part of the story. Not a tiny detail, not a small delay. The entire market setup changed on Friday night, and most people still have not caught up. The mainstream version is simple. Trump went into the Situation Room, came out without a signing announcement, and now the deal is delayed while he thinks about it. But that is not what happened. Trump did not just delay the deal. He changed the deal. He sent the framework back to Iran with tougher language, and the two areas he targeted matter directly for gold, silver, oil, shipping, and the entire commodity market this week. One provision was about what happens to Iran's nuclear material. The other was about the exact wording around reopening the Strait of Hormuz. That means the deal negotiators had basically lined up on Thursday is no longer the final version. There is a new version sitting in Tehran, and Iran now has three choices: accept it, reject it, or counter and start another round. That is not a signature delay, that is an active renegotiation. And for anyone watching gold and silver before Monday morning, that distinction is everything. I want to break down exactly what changed, why the market may be mispriced right now, and what the real setup looks like for gold and silver going into this week. Before we get into it, drop two things in the comments. Where are you watching from, and what is silver showing on your screen right now? I want to see the numbers before Globex gets moving. Let me build this carefully, because the separate facts are dramatic, but the sequence is what tells the real story. First, both negotiating teams had reached agreement on a 60-day memorandum of understanding to extend the ceasefire and begin nuclear talks. That framework was described as largely settled earlier in the week. Senior leadership approval had reportedly been communicated, and both sides were preparing to move towards signing. That was the version the market thought it was trading on. That was the version behind the optimism. That was the version that made traders think the next major headline would be a deal announcement. Then Trump walked into the Situation Room on Friday morning, after publicly laying out his demands. Iran must never have a nuclear weapon. Hormuz must reopen immediately with no tolls, unrestricted shipping, all mines removed, and no money exchanged until further notice. Those were not vague comments. Those were public red lines. He goes into a 2-hour meeting with those demands on the table, comes out and says nothing. No signing, no celebration, no final deal. Then Saturday morning, the picture changes. The framework was sent back to Iran with revised terms. Trump did not accept the deal. He did not blow it up either. He rewrote the hardest parts: nuclear material and Hormuz reopening language. That means the market thought it was watching the final step, but the actual process moved backward into negotiation. Not back to zero, but back enough to matter. And this is where the timing gets important. While all of this was happening, Iran claimed it had shot down a U.S. MQ-9 Reaper drone near the Strait of Hormuz. The U.S. side had not verified that claim. But the signal Iran was sending during the most sensitive 72 hours of the talks was obvious. Iran wanted the world to know it still had military capability, still had leverage, and still had control over escalation risk around Hormuz. At the same time, the U.S. Treasury sanctioned the Persian Gulf Strait Authority, the entity Iran created to manage and charge fees for passage through Hormuz. That is not random. That is Washington targeting the exact institution Iran built to justify control over the strait. So on the same day the Situation Room meeting produces no deal, Iran is signaling military leverage, and the U.S. is applying financial pressure to Iran's Hormuz structure. Then Iran's military command separately reaffirmed its authority over the Strait of Hormuz and warned commercial and military vessels to follow Iranian transit rules. Again, not subtle. This is not a quiet paperwork delay. This is a negotiation happening under pressure, with both sides showing leverage while still keeping the diplomatic track alive. Trump then says publicly that the United States holds all the cards in the Iran talks. He says this while the tougher framework is being sent back to Tehran. He also makes a separate comment suggesting regret over how the Iran conflict started, while still defending the U.S. military operation that triggered it. Those two things can both be true. He wants a deal, but he wants it on stronger terms than the version his own negotiators had lined up. Now put that entire sequence together. Thursday, negotiators have a framework. Friday, Trump walks into the Situation Room with public demands. Friday night, no announcement. Saturday, the framework goes back to Iran with tougher language. Meanwhile, Iran is signaling military leverage. The U.S. is sanctioning the Hormuz Authority, and the market is still trading like the deal is one signature away. That is the gap. That gap is the trade setup. Now let's talk gold and silver, because this is where the diplomatic story becomes a market story. The market closed Friday on what looked like a powerful short squeeze after a major paper liquidation cycle. Gold closed around $4,541 per ounce. Silver closed around $75.24 per ounce. That bounce was real. But the reason behind the bounce was deal optimism. Traders were pricing in the idea that the Thursday framework was basically done and only needed political approval. But by the time the market opens again, the reality is different. The deal was not signed. The terms were changed. Iran has not accepted the revised version. The timeline is stretched by several days at minimum. So Friday's paper price reflected optimism. Sunday night and Monday morning have to deal with renegotiation risk. That does not automatically mean silver collapses. It means the paper market has to hold Friday's bounce, while the diplomatic timeline becomes less certain. That is a much harder setup than the one traders thought they had. But here is why this is not simply bearish for silver. Underneath the paper price, there are two layers of demand that do not care whether Trump signs the deal today, tomorrow, or 3 days from now. The first layer is physical delivery demand. COMEX May delivery came in at 6,414 contracts, representing 32.1 million troy ounces. That was 93% above April's pace. The reason that matters is simple. Industrial buyers who cannot confidently source silver through normal supply chains because of 13 weeks of Hormuz disruption are standing for physical delivery. They are not trading headlines, they need metal. Then look at July. The July contract has 71,614 contracts of open interest, representing 358.1 million potential delivery ounces. Registered deliverable silver in COMEX vaults is around 84.1 million ounces. July 1st notice day is 21 days away. Every extra day without a signed deal is another day. Industrial buyers cannot fully normalize supply chains. Every extra day of uncertainty increases the pressure into that July delivery window. A renegotiated deal does not relieve that pressure. It extends it. The second layer is central bank structural demand. China's central bank has now bought gold for 18 consecutive months. Its April purchase was reported at 260,000 troy ounces, the largest monthly addition since January 2025. Gold now represents about 8% of China's total foreign exchange reserves, up from 3.4% 3 years ago. Global central banks added 244 tons of gold in the first quarter of 2026 alone. That kind of buying does not pause because the wording of a U.S.-Iran framework changes. That is not a day trade. That is a multi-year reserve shift. That is why gold's structural support matters so much. The $4,200 to $4,400 area is not just a chart zone. It is where central bank buying, reserve diversification, and long-term demand meet the market. Friday's bounce from around the 200-day support near $4,355 validated that floor again. So the paper market can move violently, but the underlying gold bid is not based on one diplomatic headline. So here is the actual setup into Monday. Silver closed on optimism that is now less certain than the market believed. Physical silver delivery pressure is building into July. Gold has structural central bank support that remains intact. And the biggest tension is between paper traders reacting to diplomatic headlines and physical buyers reacting to supply chain reality. That tension is what I am watching. There are three things that matter most now. First, Iran's response to the revised terms. The new framework is in Tehran's hands. If Iran accepts the tougher language, even quietly through mediators, the market changes fast. If Iran rejects it publicly, that is a very different week. If Iran counteroffers, then we enter another negotiation loop. But no response is also a response. Every hour Iran stays silent keeps uncertainty inside the silver market. Second, watch the U.S. Treasury's posture toward the Persian Gulf Strait Authority. That sanction was a message. If Washington follows it with more financial pressure on Iranian maritime infrastructure, while the renegotiation is still open, then the U.S. is negotiating with one hand and tightening the vice with the other. That posture is historically very familiar in sanctions conflicts. Talk, pressure, until the other side moves. Third, watch the registered COMEX silver vault number on Monday morning. If vault numbers rise while paper prices are under pressure, it means physical demand is absorbing weakness. If vault numbers fall while paper prices are under pressure, it means delivery demand is draining supply faster than the vault can replenish. That number will tell you more about the real silver market than most headlines. Now step back from the Iran drama for 1 second, because this week is sitting inside a much bigger structure. Before the ceasefire, before the April delivery shock, before the back and forth over Hormuz, silver was already structurally tight. The supply deficit was already large. COMEX registered silver had already been draining from its October 2025 peak. Industrial demand from solar, electric vehicles, electronics, and advanced manufacturing was already growing faster than mine production could comfortably match. That was the baseline before the war. The Iran conflict did not create the silver shortage, it exposed it. It layered a supply chain disruption on top of an already tight market. That is why COMEX delivery demand spiked. That is why July open interest matters. That is why the registered vault number matters. The physical pressure is not just a war trade. It is a structural deficit being forced through a delivery mechanism because normal supply routes were compromised. And this is the part a lot of people miss. Even when the deal eventually signs, the problem does not disappear overnight. If Hormuz reopening includes a 30-day mine clearing period, then the clock starts after the agreement is signed. After that, shipping normalizes over several more weeks. But the structural silver deficit that existed before the conflict does not vanish when the first ship moves through Hormuz again. Industrial buyers do not suddenly stop needing silver. They just regain a normal supply route. The demand is still there. The shortage is still there. The deal may reduce panic, but it does not erase the underlying problem. That is why the deal signing may not be the ceiling for silver. It may be the trigger that releases the pressure that was already building. The market thinks peace means sell the metals. But if the physical deficit is real, and if the delivery pressure keeps building, then the signing can become the moment paper shorts realize the physical market did not go away. There is another detail from this week that matters. While Trump was sending the framework back for tougher terms, Iran was still sending diplomatic officials to Doha to discuss the $12 billion in frozen Iranian assets with Qatar's prime minister. Iran's central bank governor was reportedly involved in those talks. That matters because it tells you Iran is not walking away from the architecture of the deal. If Iran were done, those financial discussions would not be moving in parallel. Instead, both sides are still negotiating multiple tracks at the same time. Nuclear language, Hormuz language, asset release logistics, ceasefire extension. The framework is stressed, but it is not dead. That is the key difference. This is a renegotiation, not a collapse. The timeline got longer. The destination may not have changed. Both sides still appear to want a deal. But both sides also want to maximize leverage before the final language locks in. That is why the market setup is compression. Gold closed around $4,541. Silver closed around $75.24. Silver is sitting inside a technical compression zone between its 20-day moving average near $76.90 and its 50-day moving average near $75.42. The gold-silver ratio is around 60.35. Right inside the historical equilibrium zone of 60 to 65. Friday's bounce looked like a short squeeze after paper liquidation. Monday's open now has to absorb the renegotiation overhang against that completed liquidation base. There is a word for a setup where paper selling is already washed out. Physical delivery demand is building into a first notice day clock. Central banks are still buying, and two sides in a major diplomatic conflict are still negotiating because both want a deal. That word is not collapse, it is compression. And compression does not last forever. It releases when the market gets the headline it has been waiting for, or when the physical market forces paper to reprice first. So here is what I want you to carry into the week. The deal did not die, but it did not get signed either. Trump toughened the terms. Iran has not given the final answer. Hormuz is still the pressure point. Silver delivery demand is still building. Central banks are still buying gold. The paper market closed on optimism, but the diplomatic reality is more complicated. That gap is where volatility lives. Before you go, 2 questions. First, what is the silver price on your screen right now? Just the number. Second, do you think Trump's tougher revised terms make the deal stronger or kill it? One word: stronger or done. I want to see where this community stands before the market fully digests the reset. And for those of you who want to go deeper, I also share exclusive weekly videos inside Wealth Academy, including the exact stocks I am buying, the investing frameworks I use, the skills I believe matter most for building generational wealth, and more. Click the join button below or use the link in the description to get access. The deal went back for revisions. The physical clock kept ticking. The central banks kept buying. The compression is real. The release is still coming. Subscribe and hit the notification bell, because when Iran responds to the revised terms, that may be the single most market-moving event of the week, and it could happen at any time, including overnight.